the most important financial story in the United States, roughly in 15 years. And more importantly, we'll tell you how to hedge and get out of the way and to protect your money from what is happening on Wall Street right now. So let's just jump right into the big number because it's $151.2 billion, give or take $151.1 billion. That's how many uninsured deposits were sitting at Silicon Valley Bank after it collapsed early in the morning on Friday. In a rare decision, the FDIC stepped in during market hours, and the FDIC only insures, guarantees up to $250,000 for bank insurance, leaving anything over that amount in limbo at the bank. So this morning, we're learning about how the Fed, the FDIC, the bank, the Treasury, and everyone else in the government is effectively backstopping this. Silicon Valley and now New York Signature Bank were taken over by regulators. The FDIC and the Fed on Sunday announced a bank term funding program to support and impacting institutions, and the Treasury's kicking in $25 billion from its exchange stabilization fund to backstop the program. But don't worry, it's not going to impact taxpayers at all. Absolutely not. Shah, how does this proposed plan square with Treasury Secretary Janet Yellen saying that the federal government won't bail out this bank? And more importantly, how does it square with her saying in 2017 that she did not expect another banking crisis in her lifetime?
Well, a little egg on her face, needless to say. As far as bailouts go, this is how it's being spun, and correctly so. This is a bailout of the depositors, not of the banks. The banks, the equity investors, bondholders in both SVB and in Signature are going to get wiped out. So it's not a rescue of the banks per se. It is a rescue of the depositors. And I think that's the takeaway from here. That's the important thing. And I think that it had to be done because if not, there would certainly be a spillover and we would see runs this morning on all kinds of banks.
We have an emergency Fed meeting this morning. So what tools do they have to address this?
The ones that they're already exercising, they've opened up the discount window on a long-term 1-year basis for banks that need to borrow from them. And they are allowing banks to hypothecate collateral that would normally be haircut 10-15% at full face value, so they can get whatever money they need to shore up any deposits and any run by depositors. And therefore, depositors should be comfortable that if they need to go to their bank and deposit, the money will be there because now the liquidity has been made available to the bank. So this should theoretically stem the crisis. But this egg on Yellen's face, I've never been a fan of hers. Policy-wise, she seems to go with the political flow rather than what's right for the broader banking regime in the United States. And this is evidence, again, of just mismanagement at the highest level, including when she was at the Fed. This is also going to create egg on the face of the Federal Reserve, who was the principal overseer of SVB.
All right, so you've been saying that the Fed's likely to engineer no landing for the economy. Where do you think we're heading now?
That's the question. We got the Fed meeting coming up next week. We got CPI, PPI this week, and I know Goldman's out there saying already that that this is the pause that everyone's been waiting for. I'm not so sure that's going to be the case. I think that really. That smacks of panic. It wouldn't surprise me to see the Fed go 25 basis points next week. I think that says, steady as she goes. The banking system is safe. These were kind of one-offs. We know what happened there. And again, the problem really is Fed credibility once again is on the line.
All right, Chris Johnson, welcome back to the show. Some of your trades went into the green as banking stocks fell last week. How did you position ahead of this sector's collapse? And what are you doing to protect your profits this morning?
Well, Garrett, frankly, this is one of those situations you look at and say, luck prefers a prepared trader. I mean, nobody saw this coming. We heard rumblings of it early last week. I had these positions on long before. We saw a breakdown in the KRE and the KBE a couple weeks before that, telling us that the financials were giving us that ominous signal that we often see when a recession is looming, and that's that the banks just slow down. I mean, business gets worse. You add a little fuel to the fire with everything that's gone on with SVB and now SBNY, and it just flames that up pretty quickly. I remember back to 2008, In 2007, I was trading portfolios for a RIA back then, hundreds of millions of dollars in positions like SBF, or not SBF, the SKFs. And really, you know what? I think what we're going to expect here is a couple of these little volatility dances over the next couple of weeks as things really get hashed out. And you know what they say, sunlight is the best disinfectant. I think a lot of sun's going to shine on these banks right now.
Yeah, that's a good point. And again, we had momentum turn negative last Monday, and then Tuesday, really the sell-off. And it's easy to sit here and to say that, oh, it was the Fed, it was Powell speaking, but it's really the undercurrent of this story that's been developing. And you don't find out until it's too late. So this is why you have to have an indicator. That's why you have to have conviction in the way that you're trading. So what are the potential repercussions that you're seeing across the sector with other banks after this sudden collapse? And are you seeing any exposure anywhere outside of the United States as well? This obviously impacts more than just the U.S. venture capital system.
Yeah, obviously here at home, you're going to want to watch the regional banks right now. JP Morgan and names like that are the names that usually come in and buy these. And I was surprised last night we didn't find anybody that wanted to belly up to these shares and actually try to buy this bank. It's got a name still. I mean, there's a brand that's worth something there. Even somebody screwed up on managing their portfolio. Outside of that, PNC turned down this deal yesterday. Look at that company because it's strong that they were in there looking at the balance sheets and they turned it down. Some of these larger super regionals are going to be interesting. The smaller, especially as we've heard, concentrated banks, anybody who's in one specific area of business, you're going to watch these start to get hit, even if there's nothing wrong. The market's going to get spooked here for a couple weeks.
One of the key things we were paying attention to was obviously the UK. The UK had been under a lot of pressure, obviously, in the last year, and a lot of people were focused on the venture capital space in London. Effectively, it wasn't going to exist today if they couldn't find a deal. HSBC bought Silicon Valley Bank subsidiary in the UK for just over $1, £1, everybody. That is what this stuff is worth now. Shah, after Silicon Valley and now Signature Bank have shuttered to present systemic risk, do you think any other banks are at risk of shutting down from this? And if so, what names are you watching?
I'm not sure that anybody else is going to be shut down on this. It wouldn't surprise me if there were banks that are shut down. This is the same issue. And then we have to get, and I think you and I talked about this months ago, where I brought up there are likely to be black swans. This is one I didn't see, but this is a black swan. With the pandemic and the money that was, and the economy stopping, and especially with the venture capital firms and all of their portfolio companies, there was nothing to do with the money. So they parked it in the bank, for example. The deposits everywhere rose. The SVB's deposits rose more than 100% in 2 years. It's over the same period. JP Morgan's rose 24%. First Republic Bank rose, their deposits rose 36.5%. All these banks have the same problems. They were flush with deposits because there was nowhere else for the money to go. And what they did was they started buying bonds. They had to do something to make money. So they didn't think the Fed was going to raise rates. They didn't see inflation coming. So they bought longer term assets against those deposits instead of matching funding and liabilities and assets in the shorter end of it versus deposits. They went further out to get whatever yield they could. They locked in whatever was it then, 1.5%, 2% maybe. And now they're underwater and all that. So there's plenty of pain ahead for a lot of these banks. As far as insolvency, wouldn't surprise me. But I've got to believe the Fed is looking at every bank right now to try and stem this, because if you see a couple more, there will be significant bank runs. And then the whole financial system is going to be in a state of flux for some time. And that's going to hit markets. So the Fed needs to prevent that. And we're going to watch it play out live.
100%. And it's going to be a couple of months before we really see what the next leg of this is. We saw the UK pension problems. This is very, very similar. You have a lot of people buying these illiquid assets, and then you have this maturity mismatch. We'll talk about that later today. Ken,